And welcome to In-Depth tonight. Are you a fan of roller coasters? Well, there's a doozy this week on Wall Street after last week's historic drop in stocks as a reaction to fears of coronavirus and the outbreak. This week has been a much different story. Stocks jumped Monday, dropped back down on Tuesday, and today closed up again. It's all over the place. And joining us tonight is Thomas A. Reuter, Senior Vice President at Stifel Reuter Investment Group. Tom, good to see you tonight.
Good to be here.
I'm going to read you what Ben Levison, a stock analyst for Barron's, said today. The stock market is experiencing big swings, but they're happening in a very wide range. As long as that's the case, the moves are most likely noise. Don't get too excited. Do you agree with that?
I would probably agree with that. And I think part of the things that we need to understand is that we've got a lot of emotion in the market. We've got the elections, and people get very emotional about election issues. We also have the virus, the contra-virus, and that has been a big concern as well. And with those two things combined with the market being at all-time highs, it just made a perfect letting some steam off, and we see the volatility. And that's what we've seen. I would mention to people is that when we see this kind of volatility, historical, and the averages show that 56% of the time, a year later, the market is higher. 72% of the time, the market's higher 3 years, and 80% of the time, the market's higher 3 years. So the real key here is don't lose your cool, stick to your plan, and stay invested for the long term.
Well, stocks seem to be fickle at times, and there's these the knee-jerk reactions. For example, the jump today of almost 1100, 1,100 points. Yesterday it dropped below 1,000 as far as the loss. Joe Biden's primary victories last night, that caused all this today. Where will we be tomorrow then?
Well, most of the market gain today happened in the healthcare industry.
Right.
And the big threat was, from the political perspective, that healthcare was going to get a lot tighter and heavier-handed regulations. So the market was a little happier that Biden got ahead in the polling. And those are things that I think that people really, on a short-term basis, get very worked up about, and on a long-term basis, that probably won't make that much difference.
And it's so easy now these days, because
all you
have to do is go to a computer, log into your 401k, and you don't have to wait on those quarterly reports.
And that's part of the issue, is that people are too reactive. They need to take a longer view. And I think if people would take a longer view of things, that they would end up with a lot more money. Individual investors, it's kind of, we were talking earlier, I don't think a lot of this is happening, at least for people that have advisors. In the last week, we've had I've had one client that did some selling. And I have a lot of clients because I've been doing this for 44 years. So I think that's kind of a proof that sometimes people need a little hand-holding and a little bit of education along the way.
And let's take a look at the board today, if we can. And this is, well, they're called the Big Three, obviously the Dow and the NASDAQ and the S&P. And numbers all high today.
Yes.
But what is amazing about this is how volatile this is because of the direction it was heading in last week. Is that discouraging people to even look at stocks?
Well,
the everyday man and woman?
I think it might be discouraging for those that haven't had a lot of experience with it. We've been using it as a little bit of an opportunity to buy good quality companies at reasonable prices that have been marked down. You don't always see these 4.5% swings on the market. We got pretty close to having the technical correction of 10%. Those do occur on a fairly regular basis in a year's time. And so that's not something that we get really concerned about.
And the Fed, of course, on Tuesday pumped some, well, potential optimism into the picture, but that backfired. Why did that happen?
Well, I think...
With the cutting the interest rate.
You know, sometimes the Fed tries to do really good things, but they get caught into the political process. I think with the elections happening right before the Fed doing it, it just created some kind of noise out there that you probably wouldn't have had other times if we hadn't had the political environment that we were having with elections. And I think that is a thing that people get really worked up about and get excited one way or the other.
What do you tell that person, say like a couple has built up a nest egg over the years in the 401k, and a few months ago they said, well, we're going to go ahead and get our money, so to speak, the distribution as you call it, in the spring, right about now. What do you tell them?
Well, you know, if it is planned right, and that's the key, normally that money would have already been set aside in a cash equivalent fund that is pretty safe and secure and wouldn't be affected by the market volatility. The other thing is that if people don't need the money and they need to take a distribution, they can take it in-kind distribution and move the stock that they own directly out of the retirement account into their personal account. Those are the kind of things, that the strategies that you can use that the common individual investor that's doing it on their own may not be aware of. So there's a way to handle that situation so people really don't get hurt in those instances.
And despite those numbers that we saw there, you've always said don't panic and think long term.
Absolutely.
And that even applies to those individuals who are in the twilight of their years.
You know, Brad, I've been doing this for 44 years. I'm not exactly a spring chicken either. I still have my money in the equity markets. I mean, especially today when you see interest rates as low as what they've been. It's kind of ironic that I've been in the industry as long, because I've seen interest rates at the highest they've been in history, and now I'm seeing interest rates at the lowest that they've been. So we see both extremes. It really doesn't change the factor that, especially when interest rates are practically at zero, you can still get a good dividend from many stocks of 2, 2.5%, 3%. That's way better than what you're going to get anywhere else in the market. The 10-year Treasury yesterday or today was under 1%. Which broke a new record.
Well, I'm hearing the closing bell right now in my ear. Tom Reuter, thank you so much. It may be a bumpy ride, but it will be interesting. Again, appreciate you lending your expertise.
Thank you.
We'll be right back.